Perfect. I think we're all set. Welcome to M&A Science Live. Putting together companies is complicated, and taking them apart is even more complicated. We take lessons from real practitioners and enable them through education and technology. Podcast series, we interview leading M&A practitioners to learn lessons from their experience. Learning proven techniques is key to optimizing your M&A practice. If you're interested in learning more, connect with us on our networking events or access our educational resources at mascience.com. I'm your host, Kison Patel, CEO and founder of Deal Room. Today I'm here with Elena Sidelnikova, a corporate development executive with 15 years of M&A and finance experience. She has led M&A teams at startups to Fortune 500. She has set up new corporate development functions, established relevant processes and structure. Elena has M&A deal experience in technology, healthcare, financial services, fintech, and infrastructure. She was previously at Deutsche Bank and JP Morgan. Today, we're going to talk about how to identify potential risks during software transactions. Elena, if we can kick things off, if you can just tell us a little bit about your background and experience.
Yeah, sure. I'll be happy to. So as you mentioned, I started my career off at JP Morgan. I started in their investment banking program where I did your typical investment banking role, where I did a lot of Excel and PowerPoint and modeling and so on in their leveraged finance group. After that, I also worked for the office of the CFO of the JP Morgan's asset and wealth management team, where I did a lot of budgeting and forecasting and comparing against actuals, and also helping the company file their 10Ks and other public filings. Up to that point, I got my MBA. So I got my MBA at Wharton and went back to finance, where I spent 10 years at Deutsche Bank. So of those 10 years, the first 7 years, I was in structured finance. So doing very hairy deals, so to speak, where there would be derivatives structured in, or commodities, physical underlying. Sometimes there would be all kinds of tax, accounting, and other issues that your client or Deutsche Bank would have to solve around. And then the last 3 years of my career at Deutsche Bank, I was in their corporate finance M&A team. So this was not actually the team that covers clients as you would as an investment banker doing M&A, but this is Deutsche Bank's internal corporate development function for Deutsche itself. So doing deals for Deutsche as a principal. So there I did transactions on behalf of Deutsche Bank, primarily in the financial services, but also in the infrastructure space. After that, I moved to another role, also a corporate development role at a company called Conduent. So Conduent, it's a Fortune 500 company. They provide tech-enabled services, and they spun off from Xerox a few years ago. So when they spun off, they actually didn't have a corporate development function really at the time. So it was still being in the process of being set up. And so my role there was to really come in and help that effort, just get that corporate development function started, and get the deals, the pipeline flowing, set up the proper procedures, all the infrastructure, the team, and everything that approval flow, right? Everything that has to be done to really get the corporate development effort off the ground. And then I would also just mention, in my most recent role, I was in a much smaller environment. It was a roll-up type situation, similar to a private equity model, where you would have an investor group come in, put up some capital, and then focus on roll-ups in the healthcare space. So that's my background.
You've worked on all sides of the deals from some pretty angles there.
That's right. Both as a banker and as a corporate development principal as well.
Awesome. Elena, I get a little bit of background noise, so sometimes if you're like picking up paper or something, it.
Okay, sure. I'll make sure to try to eliminate that.
Heads up.
Okay.
So, what is technical due diligence? What are the steps of it? And I know our theme today is more specific on software deals.
Right. So in terms of when you're thinking about a software deal, right, since that's what we're focusing on this podcast, a couple of points that are very important when you're doing technical due diligence that I like to focus on. And one is a code audit. and I'll explain, a couple of points that are important about that. And the other one is the, cybersecurity. So with the code audit, what is important is to focus on two aspects of it. And what I like to see is first, when we do a code audit, sometimes it can be done with internal resources. Often the company may not have that kind of bandwidth or knowledge to internal forces, internal folks to do that. It might need to be done by a third party. But what they're focusing on is to check on the quality of the code and for any open source type issues. So quality of the code, relatively it's self-explanatory. You want to make sure that the code is well written, that it's scalable, especially if you're buying a company that's smaller than the company that you're representing, and you're trying to then transition their product and their software code into a much bigger context where you're going to add new clients and add existing clients. It's very important that the code is scalable and can be leveraged for that and potentially for other uses that you can later add to realize your synergies. And then you want to make sure that it's well documented. So if people who might have written the code have left, you're able to trace and make changes and and know how that works. And then the second point that I mentioned is the open source check. So usually it's done by the same types of folks, often a third party, where they run checks to make sure that none of the code, or at least not very large portions of the code, are sourced from open source resources. And so for folks who are not familiar with it, why is this important to focus on it? This is because if you have open source, which is things that are out there on the internet, anyone can find it for free and incorporate it. The problem with that, is that if you do incorporate that kind of code into yours, then you might be required by law to provide your software out in the public. So whatever your output is, then you may not be able to have clean ownership, right? And potentially might have to share. You might be forced to share your code with everyone out there, even the stuff that's value added that that you've designed, just because of that input that you took advantage of. So it's very important. Often you almost always see, or in many cases you'll see some portions of it in with that are derived from open source. You just have to be very careful that it's not the the very critical parts, or perhaps some parts that are around that are less important, or you can patch around. So that's very important. And then I would just say that the other piece that I always look at is the technical team review. So the technical team, your internal folks hopefully have some expertise with what they're looking for. They would, you definitely want your business sponsor and the IT leaders to come out to look at the code, to really test it out, to make sure that it's working the way they want it. They everything's working out how they were expecting it to do. There's backup process. What is the server situation? Are they using cloud, and how's that set up making sure that that's all very well understood.
So really looking for the quality of the code. I like the view on making sure things are documented, because I think that's really important, that you have a sort of a collaborative type of code where somebody else can pick it up and utilize it and know what's going on, not spaghetti. And the other was open source and checking for that, which I think is really important, because that's something come up in our own business where, as we look to utilize open source technology, that's a big part of the consideration is, what are we obligated to if we continue to take this technology, evolve on it, and we do make it something more of a proprietary, are we responsible for contributing that back to this open source community? And then that sort of led to we're better off licensing the commercial product instead, and just having some clear licensing agreement. And that way it's part of it. But it's interesting, because I think software gets more complex, and you sort of have to look at it from these different views, because it's not just one app anymore. Everything's a lot of little things working together.
Exactly. That's right. And then the last point I would mention is, very important to look at your cybersecurity setup, and, if possible, test out what the cybersecurity gaps could be. So in some cases, you would actually have a team trying to hack in to the target and see and kind of pressure testing these. In some cases, you will just have other means to identify these cybersecurity gaps. This is a very important one. I've had a situation where we had identified a vulnerability in a potential target, and that was one of the issues that was ended up being very critical in due diligence, and a plan had to be provided for how to fix that. So that's was very something that the board and the senior leadership was very very focused on. So definitely one that has to be done very carefully.
Now, if you're doing tech diligence in our company, we do an annual pen test and we have a SOC 2 audit. I mean, do those cover the check boxes, and we simply provide those reports, or are you looking for that first of all, and then are you still doing your own pen test and assessment as well?
Yeah, so you do both. You'll ask for those kinds of things, any kind of audits, internal audits, external audits that you might have done. That wouldn't be enough though. Like, we would have to still look at your setup and check, your settings and things like did people forget to change default passwords and things on some of the hardware and so on, right? So there's definitely things that people, the technical team would look at and make sure that there isn't some gap that maybe people might have overlooked.
Got it. What people challenges have you seen that are specific to the software company workforce?
Right. So on people, so in addition to all, a lot of the standard things that you look at in, HR and people diligence, when you talk about software specifically, you have to understand your life cycle for onboarding developers and also salespeople. So some of the things I've seen, and in some cases, it takes a really long time to quote onboard a developer, right? And by onboarding, I don't mean just handing them their laptop and kind of having them set up and in systems. It's really more how long do they take to get productive, to get to get up to speed on how the company writes code, and that could take sometimes 6 months, even more than a year, where they really that life cycle or that learning cycle, rather I should say, can be very long. The same thing is for salespeople. For the salespeople to learn the software, learn that technical aspects of the product can take, in some cases, 6 months, a year. I've even seen longer. So you have to be very cognizant of what your current workforce is, and then making sure that you're able to motivate them. They're able to stay, or you have a plan to hire. And then you have to build in time, right? And it could be very extended periods of time, as I mentioned, for getting them set up and being productive, making sure that they're operating at the high level.
The software industry is no stranger to acquiring foreign talent. What risks come along with hiring employees who require visas?
Right. So here you'll see a few things. So you'll see folks on visas, various types of visas, and you always have to check that they are, what is the status? Is this person going to be impacted by an M&A deal? So sometimes, when you're doing an asset deal, where you're buying, just the assets of the company, you're not, you will then actually terminate the employees, and then you will hire them at the new company. So that could cause issues for some people, because they, if you haven't done the paperwork, or or it may take some time to do the paperwork for that person to be transferred, or the visa to be adjusted. So that's something that has to be done well ahead of time, so then you're not impacting those people, and they're not losing their eligibility to even stay in the country. The other point is, some companies, especially smaller companies, can be kind of lax about doing checking work papers, and using the E-Verify, which is the online system that the government lets you check someone's right to work in the United States. So that's something I've seen, in some cases you have to poke around, maybe do some random checks, or you have to, in some cases, if you have doubts about the strengths, of the check, you might have to, do the checks yourself. And the other point I've seen, which doesn't come up as much, but every once in a while you'll see it popping up, is that for certain kinds of visas, um, you'll have the employees to be are required to have a certain amount of years under their belt in order to qualify for those types of work permits. And then people will run these employees, or qualify them, classify them as being employed in a couple of different subsidiaries at once. And so lawyers can debate kind of pros and cons of that, right? And that or risks of that. But that's something that I've seen as well. That's has to be flagged and talked through in terms of risks that can arise from that.
That's interesting. Have you ever come across a situation where you're doing an asset deal and the outcome is potential people aren't going to be able to get their visas sort of renewed with this
No,
organization?
I haven't had that happen. So we've usually been able to figure that out, or it hasn't been enough of an issue. There's been enough time to get those folks squared away.
So there
So
tends
not
to be a
no no
path to,
nobody had to be let go, for that reason.
okay, so there tends to be a path to make that transition.
Yeah. Yeah, it just might need time, right? You might need some time between signing and closing, or just building in that cushion for those kind of things.
Great. Any other like red flags or things you look for when looking at the people side of these type of software deals?
I think just overall the founders, right? So obviously very important, one of the most important and critical pieces is making sure that the founders or the management team is motivated, is excited to join your company, and wants to continue contributing and dedicating their full efforts to that. So I think, and then, identifying the right people and who are the critical people. So beyond the first layer of the founder CEO and maybe a couple others, who is the next level down, and then maybe who is the next level down from that. So then who are the most important people that we need to make sure that they're motivated. So retaining, potentially looking at retention strategies for them, from compensation and other types of motivational strategies that you can think of, right? So just focusing on that is very important, especially as because of that knowledge base, right? In software, key clients are obviously key, and we'll talk about that later as well. But the in terms of the employees are holding that knowledge base about that code and how it works is very important.
Well, how do you like dig in past like the superficial? Yeah, we're really excited to like really know, especially if I'm on the management team and I'm going to get paid well from this transaction. And of course, I'm going to be, yeah, put a facade up about being
Right.
excited for the deal. I'm curious to know if you have this approach to sort of get beneath that to get a real sense of this person, the flight risk. Are they really going to stick
Yeah.
around?
But
Is,
you never know, right? And you can't, to your point, you can't tell, right? It's hard to tell what somebody's motivation is, especially if you don't know them very well. And probably you don't get access to that second layer until way later in the process, for confidentiality reasons. So it's hard. But I think what you can do is set up proper incentives. Make it attractive enough, and have the right kinds of incentives, with metrics and targets that they're motivated to stay around, and have it vest over time, those types of things.
good post close incentive plan.
Right.
So let's talk about how do tax issues affect deals. What kind of tax issues affect deals?
Right. So this is a topic. It's actually one of my favorite topics. I come from structured finance, and tax was always, a big deal there. I know most people, kind of their eyes can glaze over when they hear about taxes, but can actually be quite important in software, and sometimes deal breakers even, or can be nearly deal breakers. So the kinds of things I've seen is, for example, you have a corporation it's a kind of corporation that is a flow through. It's called an S corporation, where the founder, the owner, just reports the income from it on their tax return, and they have to be set up in a very, very specific manner. So the setup has to be done, so document A has to be filed before document B with the IRS. Otherwise, your whole setup could be in danger, and you may not even know that you haven't done it the right way. So what I've seen is sometimes a founder, kind of thinking they're starting a, mom and pop shop, and they're, not sure they're going to get that big. They do the filings themselves online. And then, 20 years later, it's this huge company, with a lot of revenue, a lot of employees. And then you only find out when you're doing an M&A process that you actually didn't file that document B after document A. It should have been in the right order, and your whole setup is completely at risk, right? So instead of an S corporation where you have your income flowing through to you and you're not paying taxes at the corporate level, you could be in danger of being deemed a corporation, like an C corporation, where you would actually have to pay taxes at that level. And also, you could have, if you're doing a special kind of transaction where you might be doing a stock deal, but want to treat it as as an asset deal for tax purposes. We refer to it as a 338H10 exchange. It cannot be done if you didn't file your ES corporation documents in the right, in the right way. So what can happen in the practical sense is that you're either not allowed to treat it for tax purposes. For your 338H10 election is completely not available, which can change the economics significantly to you as a buyer, or the founder can be deemed to be owing all these taxes going back, let's say 15, 20 years to whenever they founded the company, which could be, depending on what their revenue, could be tens of millions of dollars, right? Could be even more than that. So huge issue, and very difficult, very, very difficult to solve. I also find that sometimes I've seen cash flows between related entities where people pay management fees, from the left hand to the right hand, kind of, right? So when you're in a smaller environment, it can be fine. But when you're dealing with a larger corporation acquiring them, this kind of thing will be scrutinized by the IRS. So you have to be, as an acquirer, very cognizant of that, because this could be audited and could be then reversed. And then as an acquirer, if you're acquiring the assets of the company, especially if you're acquiring stock, but even if you're acquiring the assets of the company, these liabilities can follow you around. So you definitely want to make sure that that's mitigated, through various means that you might have as well. And then I would just mention, very briefly, I've seen a lot of state and local tax issues with software companies, especially. It's it's an interesting one, because you might be selling software to a client in a different state and haven't filed your local income tax returns, or maybe didn't file them in all the states that you're supposed to. And again, that could be over years and years and years, right? And that could add up to some significant money as well.
I'm writing a lot of notes down to talk to our accountant about, by the way. So I'm a couple thoughts. You're actually reminding me of a conversation I had with the CEO earlier this week, where they're growing, to the mid-sized company size, and as they're doing business in different states, some states require you to pay taxes on that software sale, and in this sort of whole Wayfair judgment has really thrown things off with that tax liability. And that now they have states that come back and say, hey, we want to see all the transactions you've done within the state. And then they're going back for those taxes.
Right.
You sort of have this pretty significant recourse that they can demand the taxes on all these invoices that you've transacted with companies in their state. And then you can't go back to a client and say, hey, 5 years ago we didn't charge.
Yeah, that's right. And it will come back, like, and again, as thinking as an acquirer, right? This is something will follow you around. Even, definitely, I know, as a stock purchase, even as an asset purchase, if you deem to be buying all of the assets or substantially all of the assets, they will follow you around. So it's something you have to, understand, and just also, whatever the statute of limitations, usually, 7 years, 6 years, something like that, and then just add up those taxes that they haven't paid and figure out what that amount is, and potentially, that's something you just have to be cognizant that potentially could be the risk you're taking for that state.
And that's where I want to get at. How do you mitigate this? Because you gave some really good examples of these tax situations that are hidden and that could potentially surface as some really big liabilities. How do you end up dealing with that? The S corp
Yeah.
person that didn't have it in there. Hey, you
Yeah,
identified it
so
and say, look, if this is a potential risk here, then what do you do?
yeah, so it depends on, very different fixes depending on the situation. So with the example I gave with the S corporation, in some cases you can actually go to the IRS and ask for forgiveness, essentially. So there's a program that for these kinds of things where it was an honest mistake, and you didn't do it on purpose, right? You've treated yourself as an S, so you never meant to do it any other way. They will actually grant you amnesty. So that's something that can be done. And the other thing is, they now have there's this whole industry that developed over the last few years about tax insurance for M&A deals specifically. So there are folks that will underwrite these types of risks. So for example, this S corp situation, you have one way where your solution is you're going to go to the IRS and you're going to identify this program, and you're going to file for this amnesty, and probably in 6 months you will get your amnesty, right? So that's what your tax counsel is telling you, but there's risk. So it's not 100% that they'll get it to you. So you can actually buy tax insurance from certain providers that they'll underwrite this type of risk and many other tax risks. So this is a great, solution. In some cases, this can be very useful, because otherwise, sometimes these deals will fail, right? If someone says this is a big dollar number, and we cannot, we can make an escrow for it, right? Let's say, but maybe it's not. Then your escrow would just have to be so large that it couldn't be workable. So then, in those cases, you can take advantage of some of those insurance products. And then for state and local taxes, you can do something similar, or usually those are much smaller, and you can set up escrows for that. Let's say for a couple of years, if nothing happens, then that escrow releases to the seller.
Wow, those are good ideas on how to overcome that.
Yeah.
Have you seen like a specific example when you saw a tax issue severely impact the outcome of a deal?
Yeah, so this was, this was one example, where I know, it was from my experience, where I've seen that, also there's been situations where, let me just think of if I can think of another big. There was one example where a founder set up a dynasty trust, like a family trust, where they were, the company was actually held through a trust, and it had a founder. One of the founders, there were actually 3 founders, and one of them was a non-US citizen at one time. And that founder is, out of the picture now. They have nothing to do with the company, but when it was set up. And so we had a situation where that, person's not being US citizen that actually busted that whole tax setup, right? So, and you didn't have, you didn't have it treated the right way. So again, like similar situation to, where you can have, the company's tax structure completely impacted by something, by some technical issue that, when it wasn't set up the right way. And it was something still that actually, it could get fixed, and you could unwind some of these trusts and, do steps to mitigate that as well. But again, feels like every deal there's a new tax problem I don't think I've ever done a deal where they weren't tax problems. So
Who,
always fascinating subject.
who do I need on my M&A team to be that subject matter expert to identify those risks?
Yeah, so you need to have, so usually you would have someone who is knowledgeable about federal taxes and state and local taxes. So in the larger company, it would probably be your head of tax and their team who would have that knowledge. They would usually have the expertise, at least to check the federal setup, as well as this, kind of state and local. In many cases, though, because the tax department is small or just doesn't have enough capacity, that would be part of your financial due diligence. So you would be hiring a third party to do your financial diligence, quality of earnings and so on. And then part of that, you can negotiate, to have a tax module as part of that. And so that could be, those kinds of things could be addressed by your, one of the bigger accounting firms or whoever's doing a financial diligence. They could definitely dig into that. Sometimes it's done by your legal team. So as part of your legal due diligence, these kinds of things come up as well. So I would say it's a kind of combination of, lawyers looking at it as well as finance / tax folks.
Whether internal or external, make sure there's a tax expert there.
Yeah, it's usually a combination. It varies on your company setup and the resources you can get. Most cases you would at least have some external component, because it's rare that you'll have all these state and local experts and kind of the right expertise to opine on those kinds of things.
What's important to understand about a software company's client base?
So this is where, this kind of question goes directly to your financial rationale and how, how valuable this company is to you. So you will have to understand, if it's if you have, especially if you have a concentrated client base, then how concentrated it is, and also how sticky are those software clients. And even though software tends to be relatively sticky, right, because it takes a lot of time and effort to implement a new system, a new software for your company, especially for enterprise clients. That said, however, there can be various they can be various degrees of attachment to the founder and the current management team. So and if those guys are at risk for leaving, then you might have clients leave as well. So it's something that you want to diligence, and usually I like to do it for any concentrated big clients via client calls. So either right before signing, or maybe at some point late in diligence, you might have client calls where you set up a time with important clients and you talk to them about how they're perceiving, what is their relationship with the client, how happy are they, what's their relationship with the company, how happy are they, what are the issues. Just try to gauge how engaged they are and how likely they are to continue with that product and with you as a company. Then
can you give me examples of questions you would ask them?
Yeah, so you would just, you would set up a time, you would have a relationship manager call them, actually whoever the relationship manager or the salesperson that normally talks to them, explain the situation, explain that this is, in the context of M&A deal, and it's still, we're looking to get some diligence done, and trying to understand because they're an important client. And then the kind of questions you would ask is just you would say, how long have you been with this company, just confirming kind of the things that you found in diligence. How how engaged do you feel that your users are with this product? Are you looking to continue using this product? Are you, like, on a scale from 1 to 10, how happy you are you with this with this product? Other features that are missing. So those kinds of things, to get an idea of their engagement. A lot of times you can tell by tone as well. So even if before you ask anything, or while you're asking, right, it's really important and you can tell what the dynamic is between the salesperson and the relationship manager and the client, and also how easy they are to get on the phone as well tells you sometimes volumes as well.
So get the good and bad. Now these are staged interviews. What about some backdoor access to due diligence or other angles to get a sense of what obviously there's
Yeah,
online
so
reviews and things like that.
yeah, I mean, you're a little bit limited to what you can do, right? Depending on what stage you're in the deal process, you may still be in a highly confidential phase. So you can dig around and ask people, just if you know any employees at that company, it can be tricky, right? Or just trying to figure out what people think about their product and what their general reputation is. So it's useful to try to do that. It's hard to do though,
What about,
without
so we're in the
giving it away.
ecosystem, we go to the same trade conferences and everybody kind of knows each other. Can I go
Right.
with other vendors and be like, hey, what do you think of that company? Or what do you hear about them? Maybe not
Yeah,
exactly the
absolutely.
customer, but it's sort of other partners in the ecosystem.
Absolutely. And then you will also get a lot of intel from your business team, right? So whoever is, your division, they're called different things in different companies. Whoever's on the front lines, doing the selling, operating the business, they will often go to those kind of conferences and they'll hear rumors, they'll hear, they'll go to drinks, right? And they'll know stuff as well. So often you'll hear things like that off the cuff from them. So those are the folks that are really really useful to talk to as well. They also, if they're losing deals all the time, to that competitor, then they're probably something you could potentially be interested in or look at as an M&A target.
What about in the customer contract itself? Are there any particular things to look out for?
Customer contracts. So I would say, number one thing, and not specific to software, is any kind of triggers that are M&A related or change of control related, right? So this is something that, and very important in software, because most companies that are implementing a system, it's like a very big effort and very big expenditure for them. So they tend to put a lot of those clauses in. And so I want to make sure that if there are any kind of change of control where the customer has the right to consent or get out, I want to understand what those are. These can sometimes hold up deals. You also have situations, and I've seen where some of the larger customers have even rights to buy a copy of the code on change of control. So this is something that can be very tricky for a deal, right? If you're buying your company, your target, and your code is really what is the chief asset of that company. And so if you have different versions of the code flying around, the customers maybe having licenses, perpetual licenses on it, you have to make sure that you fully understand those types of issues.
What type of IP issues have you seen in software deals?
Yeah, so this one maybe, just in general, in addition to the code audit and the clear title and the open source that I mentioned, I would also say that, this other example that I mentioned about people selling different versions of the code to others that may be floating out there is definitely one that I would take a look at. In some cases, it can prevent an M&A deal altogether. And in one situation, we were negotiating to buy a company, and then it turned out that they sold copies of this code to others. That would, and we're looking to potentially continue doing that. So that wasn't going to work. And then in that case, you might be able to, instead of a M&A deal, you still want that kind of capability for your business. Maybe it's better to do a licensing arrangement instead, and that could be, that could derail an M&A deal, but it could also bring up a maybe potentially even a better alternative through licensing.
It's interesting because our business, we've been approached by like white labeling the product And in that circumstance, obviously there's some variables around it because, is it just a pretty tight knit deal that it's here's a single version, who's managing it, and so forth. So I can see some complexities around that in terms of who's got rights to what, and do you actually have some proprietary IP or maybe not?
Right. Yeah. Or do you have it, but others have copies of it? And yeah, you just, you don't necessarily have control over. And how tight are those licensing agreements, right? So those kind of things, exactly.
Well, how do you look at it as a risk? Is it, hey, this somebody else could come to market with the same kind of solution?
Right. Yeah. So if it depends on what the licensing deal is, but potentially you could have, your piece of what you sold, like or if, let's say you're not buying, if you're not buying the whole company, maybe you're doing a carve out, you're just buying that particular asset, but there could be related codes or versions of the code that that company keeps, right? Whoever the seller is, and then tries to launch products with that other version of the code that maybe slightly different, but somewhat different, but not different enough for you, and that causes you to then compete against them, right? Potentially, or they could, maybe they're not doing it now, but then they have a potential to develop a product that's similar to yours or similar enough to yours.
Cool. So keep time rein on the IP. Make sure it's clear in terms of who's got access and rights to what,
Right.
and understand that when you are doing deals with other companies, what may be a potential issue for somebody that is looking at your business down the road. What are some other aspects of due diligence that come up a lot in the software M&A?
So the other thing I would also note is accounting. And this is something that has been in process for a while. So there's a new, or relatively new, it's several years old, accounting standard called SCS 606. And that is a different way to state your revenue. Many companies have already shifted to it over time. There's still some, there's been some extensions because of COVID and for smaller companies and so on. So you just have to make sure that when somebody's giving you financials, especially at a very early stage when you're just browsing, or you're just having initial conversations, that you are making sure that they are using the 606, or if they're not, then how to restate that. This could be very material changes. I've seen, most of EBITDA disappear from the years that you're forecasting, and then kind of in the black hole because it's been swallowed up by the prior years. And so all of a sudden you're looking at a much smaller company, even though nothing really changed, right? The company is still, the same product, but the way it's accounted for has changed. So your valuation shouldn't really change. It's just, it's accounting. However, the multiples are different now, and it can be, it can be, a different exercise to forecast, a different exercise to sell it, right? Because you're looking at, a much smaller EBITDA. So that's something that, can be, something that people can underestimate the impact of, just because, seemingly it's just an accounting change, but visually it can have a big impact for people.
The accounting practices. It's really interesting. I didn't think about that
Yeah.
at all.
That's another one of those topics that it sounds dry, but it's can be fascinating just because it can have such a big outsized impact on deals as well.
Yeah. So through this interview, you've made it apparent that it's much harder to do these software deals with all these little components around it. I'm thinking of a scenario, and I've seen this more frequently, and I think this is just the direction the world is turning to go towards software. What is it? Mark Andreessen, software is eating the world, and I'm seeing more and more non-traditional, traditional manufacturing company, for example, that are acquiring software companies, and it makes sense. The strategic objective is very sensible. Um, I'm curious on your thoughts around what advice would you give to a one of those traditional manufacturing companies that's doing their first acquisition of software in terms of getting them to really think about what are the unique nuances that they should be thinking about in doing that deal?
Yeah, so here I think the most important thing is managing expectations of your internal stakeholders and educating them about software M&A process, and very importantly, software multiples. So a lot of companies, like in your example of manufacturing, or perhaps some other more stable, let's say not as high growth type businesses, maybe not as high margin, they tend to not trade nearly as high in terms of multiples as a software company would. And so it causes sticker shock when you get, when you go for approvals and, folks are saying, you want to pay how much for this? And, we're trading at this and you want to pay that. And, making numbers work as well, and making it accretive can be challenging in those situations. So I think it's doing that work with your M&A strategy, with your executive decision makers, to prepare them for that agenda, right? So making sure that you're clear, you have a mandate, you have your very clear M&A strategy, and you understand that if your M&A strategy includes software purchases, then people understand what that means, right? That they understand that those kinds of companies can be some heavy multiples, and there's not going to be sticker shock as a result.
So the economics are different, so they need to understand that. When you mention strategy, should this organization really demise a specific strategy to go after the software company? Or if they start seeing some things, I'm just kind of curious, what do you think about the thinking behind that?
Yeah, so I think it's, I'm sorry, I'm just plugging that because my AirPods are about to die. One moment.
Okay.
Okay. So no, I don't think you necessarily need a specific software or technology strategy, right? It can just be part of your M&A strategy. So usually what happens is that you have a business line that have an adjacencies that, let's say, this particular product can be helped. You can enter a higher growth segment. You can be you can expand it to a different marketplace. Maybe you're picking up higher margins, other attractive characteristics, maybe geographic reach, so on, right? So it's really just part of your overall M&A strategy that you have to be really clear. And then once you have your M&A strategy set up, then you have to make a list of targets that fit that criteria. And then then you have to educate folks and have it be known, right? That these are the types of companies that you're going after, so there are no surprises later on when you haven't done all that work, haven't done diligence, and you come for approvals, and it's not a surprise. So it's not a surprise.
And you're going to pay a lot of money for those companies.
Well, so what was that?
And you're going to pay a lot of money for those companies.
Yeah, no, I think it's just like if people are not used to those kinds of things, it can be tough, right? It's something that takes time to educate and get used to and understand the value proposition.
And I think there's a lot of organizations that are making these moves to essentially disrupt their own business organization to really stay relevant with the fast changing times. So that sort of tends to be part of it as well. And then once they kind of commit to doing that, saying, hey, we got to make these changes, we're going to make this investments and get past some of the economical differences in the transaction itself, going through that process, or is there anything going through even diligence and things? And I know you've highlighted some specifics around how do you look at the IP and the code audits and things like that. Anything else that you think of would be sort of unique for this company to really consider or prep for outside of what they would do in the traditional approach of doing diligence?
Yeah, I'm trying to think if there's anything else. No, I mean, I think those are probably the main things. I mean, other than these, they would be the typical things you would always look at in diligence, which is your HR type topics and compensation and benefit plans and financial diligence and making sure your quality of earnings is there. So all of the typical things you would look at. I think those are the main points that I would highlight as a specific as a specific due diligence work stream for software.
It's the other component would be interesting would be looking at the culture side between two unique industries and sort of how that may combine or not combine
Yeah.
separately.
Well, that's actually a good point. Yeah. So that's usually something you would look at in every deal, and definitely a big one with technology, where you would have often you're buying a smaller company that has been operating very well as a smaller company, and they've been able to do things, let's say, often, in a much more agile way. They're able to kind of speed up and do stuff and run around without doing too much, kind of overhead and approvals. And then, yeah, you're getting a bigger company to swallow them up, and then you might have approvals that have to be done for certain things. So it's definitely something you wanna test out. I don't think that's a huge deal usually. Like, I haven't seen deals failing for that reason. It's usually more the hard things, like, that I mentioned, the code, the tax, the accounting, the other stuff. That's cultural issues. I haven't seen those fail, but it's something you definitely want to understand, and it's a little bit hard to test, right?
Yeah, I was gonna say, I from what I've seen, corp dev people don't fail deals for culture. Integration people might, but not corp dev people.
Yeah. Right. That's right. Yeah, and I think it's important to keep, to make those folks very welcome, right? And give them that attention as they join. So that's going to be part of your onboarding, part of your transition, HR transition as well. Just getting them even set up in the systems and helping them navigate the stuff around, even how to sign up for benefits and other things like that. Really helps.
What's the craziest thing you've seen in M&A?
Yeah, so I'll give you an example. I mean, I've seen tons of crazy things, but this one's a public example. That's I can talk about it a little bit more. So at one company, this was a divestiture that I did, a relatively significant one, and we signed a deal. And there, several days afterwards, the buyer of the deal was one of their directors was accused of tax fraud by Department of Justice, and so we had a situation, right, where there was potentially the impact of that was that we would have some of our purchase price that they were going to pay us be tainted by that person who was had an ownership stake in that company. So that was the timing of that just was really crazy. Literally days after signing the deal.
Wow. Wow.
Yeah, I mean, it's been all like kind of in the news a lot. So it's it's been it definitely was a saga for sure.
Yeah. Wow. Talk about being dramatic on that. Wow.
Yeah.
That was crazy. What you got any other stories? You got a lot in your head. Just don't name
Yeah,
any names and
I
dates.
do. Yeah, this one. I mean, this is the only like public one that I can really talk about. Many others that are more confidential in nature.
Awesome. Well, I'm kind of curious because I know you have the banking and background as well, and that tends to lend to all kind of interesting views and what you see in the deals.
Right. Yeah. No, I just had all kinds of things like people like holding up deals at the last minute, literally at the altar, at closing, because they thought there would be some advantage to be gained. All kinds of stuff. I mean, it's just part of the nature of the M&A is the drama and things happen, and then you overcome it, right? But that there's always some excitement for sure.
You have to work on that M&A therapy for how to get transactions done.
Right.
Awesome, Elena. Thank you so much for your time. I really appreciate you sharing your experience with us today.
Sure. No, Kison, it was really nice chatting with you. Thanks for having me on.
Here's to the deal.
All right. Take care.
Bye-bye.
Bye-bye.